So this is why a 4% dividend yield today is not that important, because I'd rather be getting 41% dividend yield on my money. And let me kind of break down why this might be the case for me, and hopefully maybe other people can learn from this as well too. So what we're doing here today, we're going to be talking about investing into stocks that are paying dividend yields every year, but also increasing those dividend yields, because a lot of people in the dividend space love to talk about the 4% rule. A dividend stock that's paying around 4% is ideal. But I don't want 4% today, because what I would rather have is my yield on cost being 41%, maybe even 20% or 15% ideally, somewhere along those lines. So let me kind of break this down and show you some examples of what we're doing here today. So what I wanted to talk about was how dividend yields, can be deceiving to a lot of people. 4% might look great today, but then that might be not as great in about 10, 15, 20 years when you actually want to use that money, because those companies that are paying that 4% now might not be increasing their dividends the same rate as some of these other companies. So what I want to do is actually bring over this other page here. This is from seekingalpha.com. So from right over here, I brought up Home Depot. This is just an example, so just keep this in mind. I am not telling people to invest in Home Depot by no stretch. I just personally love them, and they're in my portfolio. But this is what I'm going to kind of get at. So currently they're trading for 309.96 as of this recording, but that is actually not really important at all. What is important are the fundamentals, are the books, are everything else that is important to a stock. So once you go through all that and you decide, hey, Home Depot or one of these stocks is good, one other thing you want to look at is some of their dividend information. So I'm going to just kind of break this down as of this recording. So currently with Home Depot, their dividend yield, if you bought in at this price point on this day when we're talking about this, their yield is 2.12%. To a lot of people, that is not a lot. That's not the 4% rule. It's not even close. It's almost half of that rule, right? So they'll ignore it or they won't go into it, whatever the case may be. But I look at this and say, okay, 2% yield, pretty solid. One, I don't actually want the money today because I have to pay the taxes on that stuff because this account is in a taxable account. Now, obviously, if you got retirement, this is a whole different topic. But what we're talking about too is their growth rate. That's what's also really important. Now, here with Home Depot, you can see in the 5 years, in the last 5 years, their average has been 19.73% growth. Now, that's not actually the case in the last 2 years, I don't believe, with all the craziness that happened in the market from 2020 to 2021 and all that. But what this is really kind of going over is saying, hey, if my money is increasing more every single year from having already owned the shares of these companies, that might be more advantageous for me. And I've showed this before on the channel as well too. So if you haven't been following, make sure you do, because this is what we like to kind of go over and I talk about. And I do go over this stuff multiple times because it kind of helps people really solidify it in their heads that this is actually what's important. So again, if you bought in today, dividend yield is 2.12%. Let me just make sure everything is on screen. Let me zoom in a little bit here because this thing is really small. So this is the way this chart works. It works from left to right. So if you bought in today, now let's say you bought in 5 years ago, and let's say you put in, I don't know, $5,000, $10,000, whatever amount that you can afford at that time 5 years ago. Your yield, if you bought in on June 3rd, 2016, let's say you didn't buy any other Home Depot stock at all, you just put in $10,000 and that's it. Your yield on cost today, because of the raises that they've increased over those 5 years, would be a yield of 5%. 5%. Now, I don't know about you, but that is way more than 4% at that 4% rule, right? But back then, on June 3rd, that yield on cost, the day they bought it, was not 5%. If anything, let's see if I think we can find it right over here. The yield back then was 2016 was actually 1.94. It's actually lower than it was. It was lower then than it is today as of this recording. So the yield back then was 1.94% yield. But if they didn't buy anything more, because obviously when you buy more throughout the years, it might fluctuate the yield on cost. But if they didn't buy anything more, 5% yield. That's pretty solid. Check this out too. If they went to 10 years, obviously there was a nice spike over there, but even if they bought exactly 10 years ago, on June 3rd, 2011, their yield on cost would be 19%. 19%. That is staggeringly mind-blowing to me to be able to look at something like that and say, okay, if I'm patient enough and wait for it and have these companies that are maybe not paying the best yield today but gonna increase it tomorrow or next year or next 10 years, that's maybe where I want to put my money instead of companies that are paying the 4% now. Now, granted, there are some also great benefits of taking that 4% that you earn today and reinvesting it, and obviously having that compound as well too. But there's different strategies for different people, and whatever works best for you, please do it that way. I just want to show people this to kind of give them another option. So let me move that off screen temporarily. Let me make sure everything's moving smoothly. Okay. So we're on marketbeat.com right over here. So what I want to do is I want to kind of give you an example. So if we put in $5,000 today, right? So their yield right now is 2.12%. It is in a taxable account. Let's just say every year you could put $200 a month in a month into your portfolio. You know, obviously if you could do more, fantastic, but $2,400 in a year, that's $200 every single month. We're going to go on the lower end and say that they're going to, Home Depot, as this example, they're going to increase their dividend about 8% a year, which is lower than their 5-year average and actually even lower than the last 2 years as well. I'm just playing with conservative numbers here so you guys can get some ideas. The distribution frequency is going to be quarterly, which means Home Depot pays out every single quarter. And we're just going to go with a tax rate of 15%. And then the expected annual share price appreciation. Now, when I looked at Home Depot, they were far beyond this 7, 8, 9%. I'm going to be pretty conservative on this too and just do 8% as well on the appreciation of the stock. Again, it has done more, but just for the sake, I'm going to do it at a lower number. And then DRIP right over here stands for Dividend Reinvestment Program. A lot of different brokerages do allow you to do DRIP, which essentially is if you earn dividends, it'll put it right back into the portfolio, either sometimes as the stock that paid out or sometimes as your portfolio as a whole, which is either way really beneficial. If you are, by the way, looking for a company that does allow you to do the DRIP program and invest in dividends and stocks, I personally love M1 Finance. It's what I personally use to invest for my dividends and all my growth pretty much, except for my retirement. So I use M1 Finance, and I would highly recommend, if you guys want to check them out, to click the link in the show notes down below, because it does help out support the channel so you get more free stuff like this. And I also have training if you guys are curious on how to set up your portfolio so it looks fantastic and everything is pretty much a set and forget kind of portfolio. Now, what we're going to also do too here is click on here where it says investing for 20 years, and we're going to go ahead and calculate this. Now, this is what's really important. We're going to have some ads pop up, so bear that in mind as we go through this. Let me make sure everything is still on screen. Hey, look, there's the ads. Promised, and I delivered. Okay, so after 20 years, here's the example. So your ending balance will, give or take, this is all hypotheticals, right? About $250,000. Your total return would be about almost 400%. Now, also too, when I say this stuff, keep in mind that there are people making quite a bit when it comes to investing in higher growth stock companies versus dividend stock companies. So I get it, their returns can be higher, but higher risk, whatever works best for you. Your average annual return, because of the stock price increasing and the dividends increasing, your average return every year was about 18%. And check this out, your annual dividend income is almost $25,000. Now, obviously we could see there that's pretty much $2,000 a month, but if we really want to break this down, because they pay out quarterly, oops, I put in way too much. So 24,923.65 divided by 4, that is $6,230 every single quarter. If you, obviously, like I said, if you wanted to, that's $2,000 every single month, ideally, which is fantastic for dividends. And that's not a lot of money that you're putting in. You can see here, total dividends over the 20 years is about $91,000. But check this out. Your dividend yield on cost is 47%, higher than what we showed at the very beginning, because I kind of changed the numbers a little bit there. 47%. You started at the 2.12, which is where they are today. And then you invested all that. You could, oops, circle the wrong one. Everything's getting messed up right there. You can see here that yield would be 47.03%. That's incredible. That is just absolutely incredible, right? But you got to consider that. You got to think about that. Obviously, there's so many different options when it comes to investing into dividends or growth stocks or any of that other stuff. But it's all a matter of learning different options, where you can go with this, and what matters to you the most, because your investing style is going to be different than mine and everybody else's. So take that into consideration. Again, I'll have links to resources in the show notes down below. Supports the channel, and you guys can get started with investing today. Now, I want you to keep on watching and learning here on the channel. So click on this next video right over here. My name is Dennis, and I'll see you in that next video.